All right, what's good, everybody? Mo Commas, Sunday service. We are talking about strike prices today and options trading. How to choose the best strike price, right? And so we primarily trade options. I trade uh, calls, I buy calls, I buy puts, I sell spreads, I sell put spreads, I sell call spreads, depending on my particular setup. But the question has come up, how do you choose the best strike price, right? If you're buying calls, selling them, whatever, right? So that's what we're going to be talking about today. If you want more information on options in general, go check out some of my prior videos where I kind of delve into some of the basics of options. So what we're talking about today, how to choose the best strike price. So what is a strike price? If you know what an option is a contract to buy or sell a particular stock at a certain price at a certain time in the future, right? So that certain price is called the strike price. So if we're looking at Tesla's option chain right here, I just pulled this. The strike prices are right here in this particular category. Can you guys see my screen? Just double checking.
Yes, sir.
All right. So
Yeah.
the strike prices are right here, right? So if we're looking at where my arrow is at the 345 strike, just in terms of the language of options and option chains, right? If I were to say I'm buying the December 6th 345 strike, we are going to be talking about either calls on this side or puts on the right side, right, of my option chain. And so if I'm buying the 345 strike and we're talking about calls, we're talking about this particular price right here, which is $9.60 or $960 because one option is for 100 shares, right? And if we're talking about on the put side, we're talking about this price right here, which is $915 or $9.15, which represents 100 shares, right? So that's what we mean when we're talking about the strike price. So um, if we're talking about this one up here, it would be a strike of 300, right? And as you see, as we get higher in the money in the shaded region, the cost of the option goes up. So an option at the 300 strike would be $4,680 for just one contract. All right. So number one, what's what is the most important thing about choosing a strike price? I think is identifying liquidity. I don't care what I'm buying, right? Whether it's out of the money, at the money, in the money, I want to make sure that there is sufficient liquidity at that strike price because that is going to determine whether or not I'm going to be able to easily get in or out of this particular position. And what's more important for me is getting out. So I'm just looking at XLY, this particular ETF, which is a consumer discretionary ETF. Primary holdings inside of XLY are going to be Tesla and Amazon, as well as Home Depot as well, right? But consumer discretionary stocks. Um, Looking at the open interest is how you are going to determine whether or not there is any liquidity at a strike price, right? So looking at the call side just as an exercise, I don't see much of any liquidity at any of the strike prices, right? And for me, if you've looked at my prior videos, I'm usually looking for open interest over 1,000. That represents good liquidity for me. So on the call side, the the best strike price that I see here is the 215, and that only has 28 open interest, right? And so I don't like that. So I probably wouldn't trade anything inside of uh, this December 6th expiration date, right? So looking at the other side, just looking at the put side of the equation, December 6th expiration date, right? So I just wanted to show you this. I probably wouldn't trade XLY at all, just looking at the spreads and the liquidity, but I wanted to show you a stock that didn't have much liquidity, just to show you the difference between XLY versus Tesla, which has open interest everywhere, right? Because Tesla is traded 24/7 by a lot of people. So you can generally almost always find liquidity in Tesla. But if you're trading something like XLY, you might have to go search at the right expiration date and see if there's any liquidity. And so just understanding XLY and how options work, I generally find that the third Friday of each month is generally where the most liquidity sits. And everyone knows that date as OpX, or options expirations, wherein the most options and most stocks have expiring options. And I tend to find the most liquidity on that date. So December 20th right now is that particular date in December. All right. So what else am I looking at? Number 2, the delta of a particular option or of a strike price, right? So here I'm looking at XLF, which is the financial sector ETF. Has a lot of big banks, credit cards, and insurance companies inside of that ETF, right? The most heavily weighted is JP Morgan. I have to look at some of the other banks. It might be Berkshire too, but usually it's like Berkshire and JP Morgan, right? So looking at XLF, looking at the delta. What is the delta? The delta is how much an option price is going to move with the stock price, right? So XLF's price right now is at $51.34. Let's say XLF goes up to $52.34. This option right here, the 51 strike, is going to move 59 cents for every dollar, right? So when XLF gets to 52.34, then this price right here of $1.18 should move up by 59 cents. What's that calculation? That is $1.77, or is it 67? I'm not sure. Use a calculator. But when this price goes up $1, this price of this option, which is $118, should go up by 59 bucks, right? And the reason why I'm saying 59 bucks, because remember, this is representative of 100 shares. So it's 59 cents times 100, which is 59 bucks. So if the stock price goes up $1, then this should go up 59 cents, right? And so if we go further in the money, and in the money is in this shaded region, if out of the money is outside of this shaded region, and we're talking about the call side, right? If we go further in the money, you'll see this delta get higher, right? And so the more in the money, or the strike that is further in the money, right, is going to have a higher delta, which means the closer you get to like $1, then this is going to behave very similar to the stock price, or the ETF price in this case, right? So if this goes from 51.34 up to 52.34, and you have a delta of $1, then this option price is going to go up to $9 for every dollar of price movement, right? So that's why the delta is extremely important, and whether or not you are in, right? And conversely, you can go further out of the money, specifically if you're selling options, right? Because when you're selling options, you might want to sell, especially if you have a wheel strategy. I usually, if we're in a bear market, I might sell some cash secured puts, and then when I'm selling cash secured puts, I usually want to sell something with a delta that is lower, because I'm taking advantage of time decay, or theta, and so I might, if I'm selling, I'm more so going to want to buy, or I'm going to want to sell options or a strike price that is out of the money, specifically in my wheel strategy. If I am buying, then I'm typically buying puts or buying calls that are further in the money, because those options just have a higher probability of expiring in the money, which is what I want. So, and they move more like the stock price. If you're buying out of the money calls, like right here with a delta of 3, you know how high this stock price is going to have to go up for you to really move the price that you bought it for. So that's why I tend to buy things that are at the money, right in that shaded region, or a little bit higher. But the delta is extremely important, specifically in choosing your strike price. But once again, there is no one size fits all solution, right? Some people like trading at the money for everything, and then some people like trading heavily in the money depending on their strategy, right? You're going to hit your target faster if you are trading options that are further in the money, but then you might also get stopped out sooner, right? And conversely, you are going to have to see some more movement in the stock price if you're at the money or out of the money, to see some growth in your option price, right? Which is what you want. But that means you might be in a trade for a little bit longer, right? Because the delta isn't moving with the stock price. So even if the stock goes down, it's only going to move 50 to 59 cents when that stock price goes to $50.34, versus if you were deeper in the money, this price is going to go down a lot faster because it's going to move more similar to the stock price, right? More similarly to the stock price. Another factor, and is cost, right? I think we're at number 3. How expensive is the option? And I'm looking at Netflix for this because Netflix is notoriously expensive to buy options in, right? Even buying things at the money or slightly in the money for Netflix, it is $2,400 to buy one option contract, right? Which doesn't give you a lot of room to scale in and out, which is why if I do take Netflix, I'm more likely to sell a spread. Even though I don't see any liquidity here, I'm more likely to sell a spread because that's going to be more affordable for my budget and my trading account. I don't like just buying one option or selling one spread of something because I like to scale out of my positions. So sometimes the expensiveness of an option may stop me from trading a name. Specifically, Netflix is one of those names where if it's really expensive, I'm not buying one contract for $2,400. I'm just not going to do that. My account's not built that way. If you have an extremely large account, you might be able to scale into, right? So that is a 15% chance that this is going to expire worthless when the expiration date gets here on December 20th. So this is a very low probability option, which is why it is less expensive. So you get a lot of beginning traders that go, hey, I'm going to buy these inexpensive options. They are inexpensive for a reason. They are inexpensive because they are less likely to win. So when you're buying these things way out of the money, just understand that they are inexpensive because there's a significant chance you're going to lose all of your money trading them, which is why I try to stick to things inside of the shaded region or in the money, right? But the cost of an option can really affect my strike price. So, and this isn't a good example. Let's go look at like XLF. This is a good example. So we have something close to at the money on XLF and this December 20 strike. That is only $118 to buy, right? But as you get further in the money, right, this still isn't that expensive as it relates to my budget, right? So on my aggressive entries, my budget right now is around $1,000. I could buy what, 3 to 4 of these with my current budget, and actually take advantage of a higher delta, which is usually what I prefer. Or if I have $1,000 budget, I could buy what, 8 of these, right, at a lower delta. Right, so this one is going to move more slowly if the stock price goes up, while the 51 strike versus the 49.5 strike is going to move more closely. And actually, I'm sorry, I was looking at the 50. The 50 strike is going to move more closely aligned with the stock price itself, and you can keep going further up, right? Especially as you get closer to a delta of $1, right? Anything that's like over 80, 90 cents is going to move very similarly with the stock price. But as you see, it's going to get more expensive. Right. What else? Okay. That's it, right? So just as a wrap up in terms of choosing a stock price, you want to look at the liquidity, you want to look at the delta, right? The liquidity is how many people are there to buy and sell with you, how easy it is to be able to get in and out of that particular option when you're trading. The delta is how closely aligned does the option price move with the stock price or the ETF price, right? And then the cost is like, how expensive is it, right? What's your budget? If your budget is $2,000, $1,000, whatever it is, you need to watch the price of a particular option or sell spreads in my case, which requires you having a margin account. So that way, one trade can't blow up your account, right? So, and I like to be able to scale in and out of my trades. If an option is too expensive, it doesn't allow you to do that if you have a budget or if you're trading with a budget, which is what I do, right? For risk management. All right.
Quick question.
Yep, go ahead.
Um, Due to the fact that we're talking about this, when we do trades within the money, like say we hit a strike price within the money, I was understanding that the time decay is a bit better. Why is that when you're going inside the money?
Well, because so look at theta too. So understanding that when you have a price, so we're looking at Netflix right now. Let's look at this 845 strike right here. So the price to buy that, the ask, right? The place where people are selling this right now, where you could get in, is at $52.40 or $5,240. Some of this price is the intrinsic value and some of it is the extrinsic value. Extrinsic value is something like time decay. So look at that time decay in there. So as we get further in the money, the time decay on this strike price is less, right? Do you see that? It's 49 cents per day or whatever it is. And here, as you get further down, it's usually more. And then sometimes these things are off because we're after hours right now. But generally, this is what you'll see. There's higher time decay as you get closer in the money or out of the money. So a lot of, actually everything out of the money is pretty much all time value, because anything out of the money has no extrinsic value. Because if, let's say, this expires at 809 at less than $890, the calls that are 890 and down right here are all worthless, right? Because you wouldn't want to trade, you wouldn't want to buy shares at $890 if they're currently trading for less than that, right? You feel what I mean by that?
Yes, sir.
Anything out of the money is technically worthless if this expires, right? If today were December 20th and we had purchased an option at 890 strike, at the 890 strike, it would literally be worthless because we could buy those shares for $3 to $4 less than our option contract, right? So everything out of the money is technically worthless if we're at the expiration date. So the only value inside of these are time value, right? But because they have no real worth, because no one would buy 100 shares of Netflix for $890 when you can get them for $886, right? But
Correct.
in the money, these are more likely to stay in the money because they are already worth something. You would already like to buy Netflix for $830 when the current price is $50 more expensive, right? You see what I'm saying? So your strike, let's say your strike is
Yes.
$830. Let's say today, let's say this strike expires today. This option contract expires today. You would love to buy 100 shares of Netflix at $830 if the current price is $886. You're getting a $50 discount, right?
Yes.
That's called intrinsic value. Everything in this shaded region is already worth something, even this 885, because you would rather buy 100 shares of Netflix at $885 versus a dollar more, $1.80 more at 886. So these all have intrinsic value. That's what's called intrinsic value. These are already worth something to you. So they put some of that, like we all know that. So, right, I'm not just going to let you buy 830, I'm not just going to let you buy 100 shares of something at $830 without putting another premium on that, right? And that is theta and time value. So there is less time value eating up your option if you are further in the money. So there's a higher probability that these are going to end up in the money. And the price of the stock is already higher than 830 bucks. So this has a higher probability of being worth something on expiration date of December 20th, 2024, which is why which is one of the reasons it has a higher probability. And this is just kind of how options are priced, right? Options traditionally are hedge vehicles. So the delta is just one of these signals that tells you at this point in time, this has an 84% probability of expiring in the money and being worth something, right? Because look, do you think Netflix is more likely going to stay above $835 if it's already at 886, right? And this might change tomorrow. It might change next week because these prices and these numbers are dynamic. But options in the money are going to move more closely with the stock price as well. So if you have this delta at 830 of 88 cents, this thing is going to move 88 cents for every dollar in price movement. So if Netflix keeps going up, then the stock price is going to move up faster for those that you trade in the money. But if you're out of the money, you're going to need $2 of price movement for this to move $1 approximately, because the delta here is only 54 cents. Right? So yes, it's like a trade-off. Anything in the money or anything at the money or out of the money, like this strike price here, it's going to be less expensive to trade, but the probability that this expires in the money is going to be close to 50-50 because the delta is 54 cents, right? Or like 54% probability. Versus something further in the money has an 88% probability of expiring in the money because of where it's located. But the trade-off is it's going to be more expensive to buy. Higher probability, they're going to tax you more for it.
Makes sense.
Right? And same thing for out of the money. People buying these lottery tickets down here. That's what I look at them as. They're lottery tickets. That's why they're inexpensive. Because guess what?
Yeah.
You ain't going to win. Like most lotteries, right?
Yeah, it's like a ladder. You don't even know if it's going to reach to their limit.
Exactly. So there's a good chance that you're just throwing money away down the drain if you're buying all of these out of the money, because the probability is a 15% probability. You're buying lottery tickets. There's a good chance that none of them are going to hit. But if it does hit, it might hit big and it's going to be inexpensive, but you're buying lottery tickets down here. So I tend to trade things that are at the money or a little deeper in the money. Right. But like I said, the trade-off, the further you get into the money, the more expensive things, and the option becomes less scalable depending on your budget. If you got a big account, then this might be nothing to you. But if you got a smaller account, which is what a lot of people are trading with, and I don't consider my account at 40 some thousand dollars, $43,000 to be a small account, but it's not huge and it's not small either. So for me, like Netflix, I can't trade. My strategy is specifically buying pullbacks on strong names or strong sectors. So me, I'm waiting for a big red candle in a sector or a name that's been trending higher over the last 30 days. just to simplify my strategy, that's what it is. So if on Monday we're off to the races and everything is going up higher, I probably won't be trading any of my names that day. But if I see something in a trending sector that has a really bad day and pulls back to something close to an ATR, then that's generally where I'm trying to hop in, especially if there's like some liquidity there looking at volume. So that's my strategy. Looking at the market in general, am I bullish or am I bearish? I'm bullish because look at all these sectors that are mostly positive, right? You got gold miners, that's the worst sector. You got semis, that's not that great, right? Semis are down, gold is down. If I or gold miners, not gold specifically, but gold miners. If I were shorting anything this week, those are the two sectors that I'd be shorting. But I am not really looking at the short side of anything because look at how many positive sectors we have, right? So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, like 16-ish sectors, even though oil is kind of combined. Let's say we have like 14 sectors. There are only what 4 out of the 14 that are negative. That tells me that the market is generally bullish. So I'm not going to be shorting much of anything if the entire market is bullish. What I'm trying to do is trying to ride the wave of one of these trending sectors and or things that and some of these things I'm already in, right? So KRE, in fact, let me pull up. So just looking at the strong sector, there's a lot of strength right now. KRE, the regional banks, XLY, consumer discretionary. That's why I pulled that up earlier. Energy is up. Candidly, I am in an XLE trade right now. XLF, the financial sector, I feel like I'm in something in that sector right now, or maybe I got out last week, but I'm still waiting for a pullback. Communications looks good. Industrials look good, and then metals. That's probably where I'd cut it off. XLP and XLU and XLK look decent too, but I like to take the strongest out of the strong. So usually there are only like 3 or 4 sectors in there, but just looking at the last 30 days, there are about like 6 or 7 strong sectors right now. So that is why I am primarily bullish. So if I'm going to go build my watch list, let's pull up Thinkorswim. Can you see my screen? Can you see my Thinkorswim screen?
Yes, sir. We said,
All right, looking at XLY. So I like XLY as a sector in general. In terms of just like building my watch list, it's been one of the strongest sectors. It keeps making new highs. The issue with trading the sector itself, looking at the option chain, actually, never mind. There is some liquidity in the option chain, right? Look at the open interest. So XLY is on my list next week. All right, just building a watch list. I like XLY itself at the December 20 strike. There's plenty of liquidity going up. It is kind of expensive, but it's still scalable for me, right? I can't sell spreads on it because there's no liquidity at a strike that I would be interested in right here in December 20th. But just looking, I don't really like the difference between the spread, but this could shorten as as the market opens because we're in after hours. So you kind of got to be wary of these prices right now after hours. But then I just wanted to show you an example. Look at this one that has liquidity and the spread is 65 cents. The one with no liquidity, the spread is $4. Right? They kind of go hand in hand. That's what I've been seeing. You see some more liquidity, the spread is less than $1. Right? No liquidity, the spread is $4 again. Right? So this is why I'm saying it's very important in terms of choosing your strike, looking at the open interest and whether or not there are people actually trading that particular contract. Right? So I like XLY. Let's look at Tesla. Tesla's kind of sideways right now. It's been choppy, so I'm less likely to trade Tesla. I was in Amazon last week. Amazon is even kind of sideways. So like the sector, looks better. Home Depot. I actually like Home Depot the most, but usually Home Depot is mad expensive and doesn't have much liquidity. And yep. So XLY might be the only thing that I would trade would be the sector itself because there's liquidity problems or like looking at Tesla's chart, I don't trust it. Yes, it's trending upward slightly, right? But I don't like all of this chop here. I'd like to just keep seeing it break new highs. All of this chop concerns me with Tesla. So yeah, and I think it's kind of overextended post Trump boom, post rally. We've been looking at Tesla for a while. The previous like high where it had been like the range had been from 150 to 300 right here, and it finally broke through, but it looks like it's stuck. So I'm not trying to trade things that are stuck. I'm mostly trying to trade things that are consistently going to be going up. Do I have a multi-chart for XLY? I do not. The next sector we looked at, the KRE in general, which is part of the Russell, a big component of the Russell. I think I tried to get in here on Friday. It didn't quite hit my price, but KRE is on my list. These are the regional banks. Look at that beautiful trend upward, looking at the 21 EMA, the 34 EMA, the 50 EMA, and the 200 EMA. Looking for a pullback on KRE. I tried to get on Friday, but didn't quite hit my price. What am I currently in? I am in JP Morgan. I'm in JP Morgan. I'm in Alcoa, JP Morgan, and XLE. Right now. All right, that's KRE. What else was on the list? So let me go put that on my watch list. KRE. What else? XLF. And I've been preaching at XLF. I've been in an XLF trade. JP Morgan, I did really well on it. I took it with the spread. That did really well for me. XLF, I like much of everything. I like XLF itself. I like JP Morgan. I like Bank of America still. I tried to get a pullback on Wells Fargo. Didn't quite get in Wells Fargo Friday. I like Citi. Visa looks good. MasterCard. Everything in XLF looks good. I think I actually like this sector the most. It's been trending for the last 2 or 3 weeks. Consistently green candles going up. Look at that steady trend. This is the 34 EMA representation, 34. Like all of these are trending up. I really like the entire XLF sector. But not just the XLF itself, which usually has some liquidity. If we want to go kind of look at the liquidity in XLF, look, there's plenty of liquidity in XLF. The options aren't expensive. If we go look at JP Morgan, I'm currently in a trade, but I'm going to get out soon. JP Morgan looks good too, but the options are a little bit more expensive, which is why I took it with the spread. Bank of America looks good. It's liquid too. And Wells Fargo looks good too. And it's liquid. So literally, I would be fine taking any of those names in the big bank sector. And at first, Wells Fargo was first in class. But these, look at how similar they look. They all look alike. Like they're all moving together. So I would take JP Morgan, Bank of America, Wells Fargo, or XLF, whichever one pulls back first. Just be careful taking more than one of these names because you're going to have more exposure to the same sector. So if any of these things move up, like XLF, JP, or they pull back, XLF, JP Morgan, Bank of America, Wells Fargo, I like all of these right now. We look at XLC, I think was another. Well, first it was XLE. And I said, candidly, I'm already in an XLE trade. I grabbed XLE, I think, on this day or this day on a pullback, right? Maybe it was this candle right here. That would actually make sense. Yeah, because this was the biggest candle. I actually think I got in on this candle. I like XLE and I like CVX on XLE. And WMB. I think I was looking at CVX and there was some liquidity. Yep, plenty of liquidity in CVX. WMB. There's some liquidity in WMB at the 55 strike at the December 20th expiration date. So those are on my list too. So, but I am already in an XLE trade. So I personally may not take those because I am already in a trade on a pullback in that sector, right? So just showing you how I'm building my watch list for next week. Then XLC looked good too. Let's look at if XLC, in my experience, doesn't have a bunch of liquidity in its option chain. And I am correct. Even at the OPEX date, there is no liquidity there on either side to either trade calls or sell put spreads. So I am not going to be trading XLC itself. Google is one of the most heavily weighted in XLC. Looks terrible right now because of the DOJ stuff. Meta, the second most heavily weighted, looks terrible. DOJ stuff. Netflix, I love Netflix, but there's generally a liquidity issue there, and or the options are really expensive. I still love T-Mobile, but let me see if there's any liquidity in T-Mobile. There is. Options are kind of expensive, but there is some liquidity depending upon your account size. AT&T looks more affordable, and AT&T is trending, so I would take AT&T. And then Disney, I've been trying to get a pullback in Disney the last couple of weeks and haven't been able to hit. Love Disney too. Really affordable options, good liquidity at the OPEX date on December 20th at the 116 strike or the 115 strike. Or if you got a bigger budget and want to go more into money, even this 110 strike looks good, right? Nope, can't trade these with spreads either because I don't see enough liquidity on the put side, right? But Disney looks good, so I'm just saying inside of XLC itself, I like Disney and AT&T for me because the options are more affordable and I like the trends. And Netflix too, but I've showed you previously how expensive the options are, and I don't know if there's any liquidity on the put side for me to sell a spread on Netflix. So on inside of XLC, I love Disney and I love AT&T next week. And what else? So we looked through KRE, we looked through XLY, we looked through XLF, we looked through XLC, XLI was on that list. Oh, we looked through XLE Energy, XLI was on that list. I don't know. XLI is recently trending. The only thing that looks good to me, oh, Deere. Deere looks good, but in my experience, there's usually not a lot of liquidity in John Deere. But I could be wrong. They're just really expensive. That's what it is. There is some liquidity in Deere, but look how expensive. To buy an option that is liquid is $2,100, right? And then I can't sell spreads on the put side because I don't see a bunch of liquidity on the put side. So I like John Deere if you're just trading shares, or you got a bigger account size. But that's the only thing that I really like right now. I would like Caterpillar if it breaks this high right here, but until it does that, I don't like it. XLI itself, let me see if XLI itself has any liquidity. It did break this high, so XLI itself does have some liquidity. But no, look at the spread. It's $2 difference, $2 difference. We'll see what happens if the market's open, but I love the liquidity. I don't love the spread. So I am going to wait, I think, on the XLI sector itself until like a GE starts trending or an Uber or something, but I am going to stay away from XLI. I like the sector itself, but there's no liquidity there. So well, no, there was liquidity, but the spread was too great. The difference between the ask and the bid and the ask was too great. So I'm probably off of XLI. The last sector was XME. And I'm already in an Alcoa trade. I would like XME if it broke this high because it is trending upward, but it's kind of sideways. It's not as parabolic as I would like it to be. So, but I am already in Alcoa, which looked a little better. And I think I got in on Alcoa on this date. I'm up heavily on that trade. and I'm holding on to my runner that expires December 20th to see if this can make some new highs. But Alcoa looks better than XME. The other one that's in there is FCX. FCX looks terrible. So the only thing inside of XME that I would probably trade would be Alcoa. Again, if we got another pullback on Alcoa, I wouldn't be opposed to taking a second position on one of these. And yep, there's some liquidity right here at the 45 strike in Alcoa on December 20th. You got 8,000 open interest, and the spread difference is less than 20 cents. So there's some good liquidity here at this 45 strike. So I will put Alcoa on my list as well. So that's it. As a recap, and let me throw this on the Zoom screen so you can see it. Everybody on YouTube can. Isaac, just so you can see it as a recap, this is what I'm looking to trade next week. XLY, KRE, the XLF sector, I like JP Morgan, Wells Fargo, and Bank of America, as well as the sector itself. XLE, I'm already in an XLE trade myself, but I like CVX and WMB inside of XLE as well. I like Disney and AT&T, and I like Alcoa. So that's my watch list for next week. These are all of the things that I'm going to be waiting for a pullback on, right? So I already know this. So generally what I do in terms of my process, I wake up at 5:30, take a shower, do my thing before the market opens at 6:30 PST because I'm on the West Coast. Usually I will wait like 10 or 15 minutes in the morning, wait for the prices to kind of adjust a little bit, and then I go start marking off levels every single morning at where I would like to see an XLY pullback, a KRE pullback, an XLF pullback, right? So on these approximately, 7 to 10 names, I will go individually, go set alerts every single day looking for a significant pullback on one of these names for an entry point. And then when I get a text message or an alert that says that it's hit that point, then I'm going in the option chain. I'm looking for a price at a strike price that I think and an expiration date that makes sense for me. If I'm selling spreads, I usually want a closer expiration date. If I'm buying an option, a call, or a put, then I usually want more time. So I usually want to be 3 to 4 weeks out if possible, wherever there's liquidity too. And that's essentially what I do every single morning. And that price is going to change every single day because I'm looking for a pullback based upon like the prior day's price, right? So if tomorrow we have a slight down day that doesn't hit like close to like 75 to 80% of an ATR, I'm not going to hop in on that day. I'm going to wait for Tuesday. And if we have a bigger down day on Tuesday and we're still trending, that's the day that I'm going to get in. So I'm waiting for a really bad day that's close to the volatility, and my volatility measure is usually the average true range, and then I'm also looking at volume on the chart to figure out where are the institutions buying based upon like the last 20 days of price movement, and trying to get in just before those levels hit. Also where the stock is really exhausted. So I want extreme exhaustion and some liquidity. That's typically in a trending sector, a name inside of a trending sector. Those are primarily the three things that I'm looking for. And then once I get that extreme exhaustion, I'm trying to get out, or I'm trying to get in towards the bottom level of that extreme exhaustion and then riding it up. Because if the name is trending or the sector is trending, I'm anticipating that trend to continue even if we've had one bad day. One bad day doesn't mean that the trend is over. It just means there's a bad day. Stock prices usually tend to go up and down. So I want something that has been consistently going up, and I want to grab it when it's had a really bad day. All right. And that's pretty much my strategy. So before we leave for today, is there anything else that you guys want to look at? Any particular stock?
I'm sitting on that right now.
I can't hear you. You cut out.
I said I'm good with that. Everything you provided was good enough.
Okay, for sure. Yeah.
I'm good too. Appreciate you.
All right, for sure. Mokamas Sunday service, making it rain without the umbrellas. We're here at 8 a.m. every Sunday, just looking at the market to try and help you understand it a little bit better and just showing you what I'm doing candidly. Like I'll show you my long-term accounts this year, man. I'm up 40 bands. My trading is down. And I've been telling you guys that consistently. My long term investment strategy has been doing way better than my trading strategy. But once again, I've been investing way longer than I've been trading. I've been trading the last 2 or 3 years, had one really bad trade last month, been trying to claw that back with some of these decent trades that I have been having. But I'm still learning myself. But like, to be honest, my Shopify leaps, have been going crazy this year. I'm up 20 bands on 2 leaps this year. And those are up, I think, 150, 160% right now. And what I've been saying is what I generally like to do is go find a stock that's exhausted from a long-term standpoint on a weekly or on a monthly basis. If it gets down to that 200 EMA, that's a good buy point for me, especially if I can go find some liquidity a year out, a year and a half out with a leap, and I go deep in the money with my leaps. But those have been going crazy for me this year. Like, I made like 4 or 5 grand on an Apple leap this year. I'm up 20 grand on Shopify leaps. I'm up about 10 grand on Google leaps. To be honest, that's been my best strategy this year, is finding really good companies that have had some extreme pullbacks or really bad months, buying close to a really decent fib level where it's at least 20 to 30 to 40% off, and then buying a leap further out. Did that on Google this year, Apple, and Shopify, and all of those have been hitting. But yeah, so that's I can't complain. We're at the end of the year and I'm up 40 bands, and overall, even including my trading losses, I am still up 40 bands on the year. So till next time,
Nice.
fellas.
Yeah. All right, real quick though, off the record now that we done talking about the stocks.
Hold on. Let me
Okay.
get us off our line before you
Well,
start
I'm still
going
gonna be
in.
talking about the market, not nothing crazy. Yeah.